Hi all, now we are going to learn about market equilibrium. Okay, so in a market system, the prices for goods and services, either goods or services, are determined by the interaction of demand and supply. So we have learned a lot about what is demand, what is supply, how the price and demand are related, how the supply and demand are related, all these things, right? So in a market, there will be an interaction between the demand and the supply. So that is how the price for goods and services are determined in the market. Clear? So a market is any place that brings buyers and sellers together. So how can we define a market? A market is any place that brings buyers and sellers together. And markets can be physical or virtual. So we know that a lot of nearby markets, right, where we go to the market and purchase things all over. And we also have some virtual market. What are our virtual market? We have Amazon, we have Flipkart, Mindra, eBay. A lot of online platforms are there where we can select the goods, we can make the payment, and it will be get delivered at your doorstep, right? So that is virtual. So we have both physical and the virtual markets, right? So buyers and sellers meet to trade at an agreed price. So you know that whenever you are going to buy something at a supermarket or any other outlets or open markets, etc., you can see some price tag there, right? So there will be some determined price out there, right? So all the purchase will be based on the agreed price only. So buyers agree the price by purchasing the goods and services. Okay. So basically what is happening, the buyers and sellers meet to trade at an agreed price and buyers agree the price by purchasing the goods and services. For example, when I'm going to buy a phone, it is listed at around 15K. Okay. It is listed for 15K. So if I am buying that, which means I'm agreeing for the price based on the quality, the options, or all the facilities it's providing, it's worth 15. I value it for 15K, so I'm buying it. So buyers agree the price by purchasing the goods and services. In some case, we may not purchase it, right? Because we do not agree with the given price. If they do not agree on the price, then they do not purchase the good and service and are exercising their consumer sovereignty. So whenever you go into a market, it is not mandatory that you should buy it, right? Whether you like it, you can buy it. Or if you are not able to purchase it, or if you think that it doesn't meet the requirement for certain price, you don't have to buy it. It's your choice. So the consumer have sovereignty whether to buy it or not. So we have three things we mentioned here. First thing, at the market, buyers and sellers need to trade at an agreed price. So there will be an initial price listed. And if the consumer agree with the price listed from the producers, they will purchase it or they will leave it. Okay. So that is why the consumer have sovereignty. Based on this interaction with the buyers, sellers will gradually adjust their prices until there is an equilibrium price and quantity that works for both parties. So, as I mentioned, based on the cost of production, the transportation, and all other costs are, associated with the production process, the producer will be setting a price. Sometimes the consumer might think that uh, it's literally high or it may be low, something like that. So, when the prices are too high, mostly what will happen? The purchase won't be happening, right? People won't be buying that. And if the price is too low, the product might get sold too quickly, right? So, both can be happening. So, whenever the product is not sold or whenever the product is sold over in number, there will be some adjustments. Okay, so that is how they reach at an equilibrium where all the products supplied will be sold out. Okay, so at the equilibrium price, the seller will be satisfied with the rate of quantity of sale. Okay, the rate of quantity of sales. And at the equilibrium price, buyers are satisfied with the utility that the product provides. So both are getting to a satisfied form there. Okay, the producers are satisfied and the buyers are also satisfied. So let's see how the equilibrium will look like. So at equilibrium, so equilibrium in a market occurs when, as we mentioned, demand is equal to supply, right? So at this point, the price is called equilibrium or market clearing price because all the products supplied in the market will be sold out. That is why it is also called market clearing price. And this is the price at which sellers are clearing their stock at an acceptable rate. So this is the price at which sellers are clearing their stock at an acceptable rate because these are accepted by the buyers. So they are buying at that particular rate. So let's see how to represent them using a graph. So you can use a normal demand supply curve. So here we have the x-axis and y-axis. Y-axis with the price and x-axis with the quantity. And you can see the demand curve and the supply curve. And you can see the demand curve and supply curve is getting intersected at a point. So this is the equilibrium pricing. So here the number of quantities supplied is getting uh, sold out. Okay. So this is our equilibrium quantity and equilibrium price. So P1 is the equilibrium price and Q1 is the equilibrium quantity. So you can see that if the price is above this, okay, so the product won't be sold out completely, right? So at this point, they had around this much quantity supplied, but only this much is demanded. So there will be some leftovers. Sometimes there will be some extra, like shortages will be there. Okay, so it is possible. So this is the equilibrium case where the quantity demanded is equal to the quantity supplied. So any price above or below P1 create disequilibrium in this market. So as we mentioned, any price point above or below, both above or below this P1 rate will create a disequilibrium. Like sometimes the consumers will profit more and sometimes the producers will profit more. So at that time, the quantities won't be clearing out from the market. So disequilibrium occurs whenever there is an excess demand or excess supply in a market. So this is how you have to answer a question related to market equilibrium. Okay.